Hello and welcome to Principles of Microeconomics. This is Module 5.1 and we'll be talking about understanding profit and the production decisions of firms. So to start off with, recall that all firms are going to be interested in trying to maximize their profits. And profits are the difference between total revenue and total costs. So therefore, if a firm wants to maximize profits, it is going to be looking at trying to maximize total revenue as well as minimize total costs. Now, when we're thinking about the production decisions of firms on an economic basis, we need to think about it in terms of economic costs and economic profits. Now recall that one of the most important concepts in economics is opportunity cost. So when we think about the economic costs that a firm faces, we're thinking about this in terms of both explicit costs or financial costs, as well as implicit costs or opportunity costs that a firm faces. Let's look at an example to explore this in greater detail. Let's say that our friend Caroline can use $3,000 of her savings to start her firm, which is in a savings account that is paying her 5% interest. Now, Caroline needs $300,000 to start her new business. So she can take that money straight from her savings, but that savings account is paying her 5%. On the other hand, Caroline can borrow $200,000 from her bank at the same interest rate and use $100,000 from her savings. The question is, what should she do? So let's look at choice A. So she wants to start her business. She needs $300,000. The explicit cost is $300,000. But now the implicit cost is going to be her foregone interest income that she could have otherwise made if she kept that $300,000 in the savings account. So that $300,000 is gaining 5% interest each year. So by pulling out the $300,000, she is losing the opportunity to gain $15,000 in interest income. So her total economic cost is going to be $315,000, the sum of her explicit costs and her implicit costs. Now, if you asked an accountant would say that her cost would be only her explicit cost, the $300,000. Now, what about choice B? Now she has to start her business. She still needs that $300,000 to start, but her explicit cost is going to be the $200,000 that she takes as a loan from the bank, plus her $100,000 that she takes out of her own savings, plus the interest that she needs to pay back to the bank on that loan. So she's paying 5% back on that $200,000 that she takes out from the bank. So her total explicit cost is going to be $310,000. The implicit cost is going to be the loss of interest income that she has from pulling the money out of her savings account. So that $100,000 would have otherwise been making 5% on an annual basis if she kept the money in the savings account. So her foregone interest income is $5,000. So the total economic cost, the sum of the explicit and implicit cost, is $315,000. But her total accounting cost is $310,000. So for an economist, they would say it doesn't matter if Caroline chooses A or B. She's faced with the same cost if you account for the opportunity cost. Now, this is going to be important to keep in mind because as we move forward, we're going to talk about the optimal production points where we're maximizing our profits. We're going to be talking about maximizing economic profits, and therefore we're taking into account total revenue and total economic costs, which account for both the explicit and implicit costs. So when we look at maximizing profits, we're looking at total revenue, price times quantity, as well as marginal revenue, which is going to be the change in total revenue divided by the change in quantity. Marginal cost is going to be, recall from Module 4, change in total cost divided by the change in quantity. Marginal revenue is going to capture the change in a firm's revenue from producing one more unit of a good. whereas marginal cost is going to capture the change in the firm's cost from producing one additional unit of the good. So remember, with marginal analysis, a firm is going to be interested in understanding the changes in costs and the changes in revenue on a per unit basis. That's going to be the best point of comparison for them to understand exactly what the optimal decision will be. Okay, so when we look at the profit maximizing point of production, for all firms that are trying to maximize their profits, the best point of production will be where marginal revenue is equal to marginal cost. This tells us that the additional revenue that a firm generates from producing one more unit is exactly equal to the additional cost of producing one more unit. If marginal revenue is greater than marginal cost, the best thing to do is for the firm to produce more. On the other hand, if marginal revenue is below marginal cost, the best thing for the firm to do is to produce less. The point where marginal revenue is equal to marginal cost and the firm is maximizing its profits. What we know in that case is that the firm cannot increase their profits by producing any more or any less than at the point where marginal revenue is equal to marginal cost. So at this point, what we say is that the marginal profits is equal to zero. Or in other words, the additional profits that the firm would get from producing one more unit is equal to zero. Thank you so much for joining me in Module 5.1 on understanding profit.